Well, good afternoon, and thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is Diversified Gas and Oil, who announced their half-year results on Monday. So can I just start by saying we're really pleased here to have with us Rusty Hutson Jr., co-founder and chief executive of Diversified Gas and Oil, alongside his colleagues Eric Williams, CFO, and Brad Gray, the COO, as well as Teresa Odom from Investor Relations. So thank you for joining us all the way from the States. Before the presentation commences, I'd just like to go through a few points. You're currently all on listen-only mode, and if you want to ask a question, please type it into the Q&A box at the bottom of your screen. We've had a few questions sent in ahead of time, and we'll cover all questions at the end of the presentation. The format today is a presentation from Rusty and his management team, which will last about 30 minutes, and then we'll have 10 to 15 minutes available for Q&A. Following the meeting, you'll be directed to a short survey, and it'd be really appreciated if you could spend a few moments completing it. And so just before we start, short introduction. Diversified Gas and Oil is an independent owner and operator of producing natural gas and oil wells concentrated in the Appalachian Basin in the United States. Their field operations are densely located throughout the neighboring states of Tennessee, Kentucky, Virginia, West Virginia, Ohio, and Pennsylvania, where they're one of the largest independent conventional producers. They've grown rapidly over the last few years, capitalizing upon opportunities to acquire and enhance producing assets in their region of focus and leveraging the operating efficiencies that come with economies of scale. Diversified has distributed regular and increasing dividends to shareholders and targets shareholder returns of 40% of free cash flow, and their latest quarterly dividend showed an increase of 7%. There's been a huge amount of progress this year, and I'm now going to hand over to the Chief Executive, Rusty Hutson, who will take you through the presentation. Rusty.
Thank you, Alex. We'll start here on page 3 of the presentation. I'm just going to spend a few minutes giving an overview of the first half of the year in terms of the way that I've seen it sitting here as the CEO of the company, some of the highlights that I feel like are very important to understand about the business. Number one, very challenging environment through the first 6 months of this year. Very pleased to know that the company is set up in a way that has insulated us from some of those issues that have occurred, from a volatility of the commodity price environment to the pandemic, obvious economic conditions across the globe. In the midst of all of that, we still saw a 55% EBITDA margin, cash margin on the business through those first 6 months in a very challenging commodity price environment. Our hedges, which we tout a lot about and talk a lot about, were very effective in maintaining a very strong cash flow through the first 6 months. Hedge floor that we recognized at about $2.69 in the midst of a half year that was $1.83 on average. The other positive note as it relates to that margin is our cost structure and the way that we manage the business and operate on a very efficient manner with our total cost on a per MCF basis of $1.17 with G&A included. So an all-in cost of $1.17. The hedge book that we have in place effectively held our margins at very high percentage at 55%. A couple other things to note here on this first page, 32% free cash flow yield in the business through the first 6 months, and couple that with a dividend yield that currently sits at 12%, tells me a couple different things. Number one, that we have a lot of cash flow, obviously. We're not only distributing to our shareholders, but we're also, earning enough cash to also pay down and reduce our debt levels alongside of the distributions. So we definitely are flowing a lot of cash, and that these high yields would insinuate that the share price is undervalued at its current amount or at its current price. Last thing here on this page is just overall the balance sheet in general. It says a lot about the approach to the growth that we do. We've closed a couple of transactions in the first half of the year. We're very disciplined in our approach and how we fund those transactions. Our debt leverage ratio is 2.2. 70% of our debt structure is in long-term financing, fixed coupon, principal and interest amortizing and hedged over the life of those notes to solidify the cash flows that is necessary to pay those down. The overall average yield, weighted average yield on our debt is about 4.7%. So it's been a very strong first half of the year with a very difficult backdrop. Real quickly, to walk through just a few highlights in addition for the first 6 months. We've now surpassed the 100,000 BOE per day production mark. We're up to 109,000 BOE per day. Really of note is embedded within that 109,000 is a base legacy conventional production that has now maintained a 0% decline rate for 8 straight quarters. And it's extremely important in the way that we run our business, because it that 70,000 BOE per day underpins our production profile, but also underpins the cash flows in the business. That gives us a lot of visibility into the dividend payouts over the long haul. You'll see on Monday we announced an increase of 7% to our quarterly dividend, which is payable in December, of 3.75 cents per share. We also completed the uplist to the main premium board of the London market back in May, alongside 2 acquisitions that we closed for $235 million of upstream and midstream assets, and that integration is ongoing as we sit here today. We also completed 2 financings. One of them was a second tranche of our ABS funding source that we started back in November of 2019. This was a second tranche for $200 million, with the lead investor in that being TIA here in the U.S. And then we also had a term note with Munich Re for $160 million to help fund those 2 transactions that we closed. We also completed an equity raise in May for $86 million. That was 3 times oversubscribed. First half EBITDA was $146 million. We talked about the EBITDA margins, the way that our LOE and our operating expenses continue to trend down over the last 2 or 3 years. Free cash flow yield of 32%. We sit here today with a very strong liquidity position of $220 million. And very importantly, our borrowing base was reaffirmed with no change in amount available or in pricing as of the spring redetermination at $425 million. As it relates to COVID and the impacts, we've seen little to no impact at all from the in our operations from the pandemic. Probably the biggest impact to us has just been the inability to be in London as we sit here today doing these road shows to our investors. On page 5, just real quickly, and we'll turn it over to Brad to do some operational updates. Our business model, the one thing that we're very clear about and what we continue to emphasize every time we do a presentation is that our business model doesn't change. It stays the same. We acquire assets, producing assets. We look to optimize both the production side and to become as efficient as we possibly can on the operational side and in our expenses. And we're producing a lot of cash flow as we do that. We use hedges as our friend. We like to minimize the downside or minimize our exposure to the downside in the pricing of our natural gas and NGLs. We generate very strong cash flows, as can be seen with the free cash flow yield and dividend yield that we're paying. We told our investors since day one we're going to pay dividends, and we're going to be progressive as we add additional assets, as we add additional net revenues. We're going to increase that dividend, and we have over six consecutive times now. And in the midst of when everybody else has been cutting and reducing and eliminating dividends, we just reported an increase. And we'll do all of this with never putting the balance sheet at risk. We know that keeping a clean and robust balance sheet will pay dividends for us long term, giving us the ability to grow the company in any type of environment that we're currently in. So all of that is continues to be our emphasis as we execute on our business model. With that, I'm going to turn it over to Brad to talk through some more operational slides.
Thank you, Rusty. We'll start with production. And currently our production stack, we put into 3 categories. As Rusty mentioned earlier, we have a very stable production base from our legacy assets, and the stacked bar chart on the left gives a good visual of that. We've been very focused to make sure we're optimizing and enhancing production at every opportunity that we have. We have 4 daily operating priorities. Number 1 is safety, number 2 is production, and we say every unit counts. 3 is efficiency, every dollar counts, and then 4 is enjoyment. We want to have fun at what we're doing. But with number 2 being production, we are constantly evaluating opportunities to improve our production, and we're pleased with the results that we've been able to achieve. And really in the first half of this year, with all the uncertainty around the pandemic and all the challenges that we had, we were very pleased that our team was able to stay focused, stay diligent, and committed to achieving our priorities. We also have a group of unconventional assets that we acquired from HG Energy and Edgemark from 2019. Those wells produce larger amounts on a per well basis. They're performing within our expectations, and we've been able to actually improve some production from those wells. Additionally, we've been able to get some good cost efficiencies built into those well pads, and that's helped us improve margins. And then the last component of our production are the recent acquisitions that we completed with Carbon and EQT. With the addition of these wells, this has put our June exit rate at 109,000 BOE per day. Those wells have performed slightly better than we had anticipated or built into our diligence process, and so we're pleased from that standpoint. So this current level of production puts us as the largest independent producer on the London Stock Exchange. Moving on to page 8, over the last couple of years, we've been able to aggregate some nice midstream assets, and our focus on our midstream assets is not to be a separate midstream company transporting gas for other parties. Our focus is to be a midstream company for our own production, and that's given us some great vertical integration opportunities. The 3 primary elements of this vertical integration strategy, number 1 is we have flow assurance. We've got control of the pipes, the compression, and the personnel, and that'll gives us a lot of optionality and flexibility. Number 2 is with that control, as well as with the scale that we've put together, we have the ability to move gas into higher priced markets. So we can move gas from a NYMEX minus market to a NYMEX plus market, and when these pipeline systems were segregated, the previous owners did not have that ability. The third is that we do have third-party producers that feed into our midstream assets, and so that provides us with a revenue stream, which really helps us offset our cost of operation. And as Rusty started out his presentation talking about our EBITDA margin, that really helps us enhance our operating margins. I'm going to move forward to the next page here. We'll talk some about ESG. As discussed in our chairman's report that was with our earnings release, our focus on all elements of ESG continues to be very comprehensive. Our business model and our daily strategies and priorities are aligned with our formal ESG efforts. And wanted to highlight a few of these today. We're very engaged with the states in that we operate, and we were able to work with the state of West Virginia to help craft legislation to provide some funding for the state for their orphan wells. In addition, part of that legislation, it also lowered our severance tax in the state, and so that was a win for all parties. We've recently acquired some remote equipment that we will use to help improve our methane leak detection. It was a very affordable equipment that we believe will give us big payoffs, not only on the revenue side from getting more sales and more product sales, but also just from a methane reduction standpoint. We've got over 1,100 employees in our company. So we're very engaged in their productivity and their health and well-being. We've recently rolled out a tuition reimbursement program that all employees have the opportunities to expand their education with. As Rusty mentioned, we've had very little impact from COVID. We've had 0 layoffs, no salary reductions, and in fact, during this period, we're able to increase salaries for a large portion of our field employees. Also, we provide a tremendous benefit package to our employees. During this period with the carbon acquisition, we brought on 125 new employees from carbon. We also converted one of our largest third-party contractors over to be a company-owned employees, and all of those 190 employees received expanded and improved benefits. From a governance perspective, we have a very comprehensive risk management program that covers all aspects of our business. In this presentation, we're highlighting several factors related to safety. We have a new incentive program for our field employees that we call Safe Passages. We've installed GPS devices on our fleet to make sure that we know where our employees are to keep them safe. And then for the processing facilities that we have, we're continually looking to improve and enhance our PSM practices in those facilities. A couple of updates on our acquisitions. It's important that we spend a lot of time doing diligence and determining what the benefit of the acquisition is going to be for our company. And in many cases, we build in some synergies at the beginning. And so we're pleased to report that for the carbon acquisition, we anticipated being able to reduce their payroll 25%, and we were able to accomplish that, and that was a significant margin enhancement to the addition of these assets. And then, as I previously mentioned, we also converted a third-party contractor relationship in the state of West Virginia over to company employees, which allowed us to get consistent field operations, simplify our business, but also be able to record about $600,000 in annual savings. From a midstream perspective, with the assets that we acquired in the fourth quarter of last year, the pipeline assets, we had identified the opportunity to move gas from a NYMEX minus market to a NYMEX plus market of about 24 million a day of production. With the addition of the carbon acquisitions, we're able to connect some additional pipes to move gas further into that more positive market. And so we think we've identified, at least initially, an incremental 20 million a day. So that put us about 40 to 45 million a day of gas production that we can move into a NYMEX plus market. Not only do we want to be successful in integrating the assumptions from our diligence, but once we get the assets, we want to optimize them. And we want to put our teams and their experience and knowledge in place to go find additional margin enhancements. We've talked over the last couple of years about smarter well management. We're making a slight change to that. We're changing it more to be focused on smarter asset management, as we not only have upstream assets, but now we have a significant midstream compression pipe assets as well. So we're looking to optimize those in every way that we can. With our EQT acquisition up in Pennsylvania, we were able to determine that we could dispose of water at a much more economic level than EQT was, and we cut that cost in half, as well as the drive time, which was favorable to emissions. From one example of what we did with our carbon acquisition, with a lot of the scale and overlap of assets, we have redundant pipelines and compression. Within the first 45 days of the transaction, we were able to remove redundant compression, which saved us $115,000 per year, as well as allowed us to optimize our gas flow and get some additional gas flowing of about 700 a day. We also acquired 13 non-producing wells from EQT. We're in the process of evaluating those and developing plans to bring as many of those online as possible, and we would anticipate that we would have some new production flowing from those in the fourth quarter of this year. On the last page for my section is some real tangible examples around smarter asset management. You see our good results from our metrics perspective. These are the tangible examples of how we do this on a daily basis. And I think the key word on this page is really continuous. We really do, based upon our scale, size, and overlap of assets, the opportunity to really drive continuous synergies throughout all the areas that we operate in. And we think we'll have the ability to do that as we go out for the remainder of the year. So with that, I'll turn it over to Eric Williams.
Thanks, Brad, and thanks again, everybody, for joining us. I'm really happy to see some new names taking note, and I hope you find this helpful. I'll pick up on 14, and the slide speaks for itself, but really a differentiated model, you'd expect to yield a differentiated result, and it does. I think it's important to remind, we start out looking at the 67 E&Ps across the space in the United States. And when Rusty took the company public just 3 years ago, we were the only company out there that was just exclusively talking about focused on cash flow and not focused on growing production through development. Today, that's very different. There's a lot of companies, even those who are focused on development, they're talking about tempering development programs to focus instead on cash flow and tangible results for shareholders. But it's difficult if you don't build the organization around that premise to ultimately pivot the machine. And these numbers somewhat speak to that. If you look at free cash flow yield or regular dividend paying, less than half the universe in either category meets that description. So it's rather remarkable that more than half of U.S. E&Ps do not have a positive free cash flow yield and pay no dividend. If you take that one level further, you see that within Appalachia, just 3 E&Ps have a positive free cash flow yield, with Diversified more than double that of its nearest peer and 10 times that of the only other peer, with a 32% free cash flow yield. And then on the dividend basis, while just 48% pay a dividend at all, only half of those have been able to sustain their dividends through the downturn, and Diversified is the highest of any of that group. But as Rusty said, it's underpinned by very strong and stable both production, cash flow, and balance sheet. Since going public, we've grown our dividend 270% from 5.4 cents to an annualized 15 cents. So very, very positive results from a strong model. Turning to 15, talk a little bit about revenue, but rather than focusing on what's rather obvious, and we talked about using hedging proactively to maintain very stable cash flow. You see an upward to the right revenue stream, and even with a 23% reduction in Henry Hub pricing from the second half of last year to this year, you see revenue up just slightly with hedges stepping in to do what they're designed to do. But most importantly, on this slide, we wanted to illustrate the positive outlook for natural gas. And if you look at the sector in the United States, you've certainly seen that their stock prices have reflected that the market is increasingly more bullish on the outlook for natural gas and much more constructive. And we needed to see oil rebalance to levels where we see it for the markets to gain real conviction that the supply demand will come into balance. And you see, if you look at we've shown 2 different price curves, one in early April or mid-April, and one just a couple months later in early August, and you see a meaningful step up in that curve. Very nice contango coming back in. And on page 30, I won't turn there, but if you'd like to footnote it, page 30, we show illustrative cash EBITDA margins at various price points, and at $2.50 gas price, we earn a 53% cash margin. So seeing these prices on the screen certainly bode well for future margins, as well as allowing us to continue to layer in additional hedge protection in those outer periods in order to make sure that we deliver strong cash flows. Turning to 16, Rusty and Brad have both spoken to the underlying operation and our relentless focus on costs, and it shows up in the numbers. Overall costs, inclusive of that significant expansion of our midstream asset, the investments we've made in our people and in our governance, overall costs are down 15% year over year. And if you look at our operating expenses, the portion of that we most directly control, so that $3.78 in the first half of 19, declining all the way to $2.50 in the most recent period, that's inclusive of those exceptional benefits that we offer to our employees. It's inclusive of all of the maintenance we do on our wells. That's an all-in cost component. And then further, we highlight that the production taxes and gathering and transportation that we pay it's very highly tied to production. And so as our production changes, so too does that underlying cost, which gives us a very stable cost structure to have conviction to hedge longer term and lock in those returns. The only other thing I'd feature here, we'll get a lot of questions around our midstream assets, and it's because historically, midstream assets have traded at higher multiples. I think you're seeing that compress in more recent days. But we fundamentally said that we think that the midstream is intricately tied to the upstream and should be about enhancing margin. And so we look at it as very enhancing to the underlying business. But if you were to take the numbers and you looked at the third-party revenues that we receive from others to flow gas on our system, effectively it subsidizes over 25% of the cost of operating the system. And so it reduces our cost of what we pay to transport to market to just $2 a barrel with 34 cents per MCFE equivalency. So very, very compelling cost structure underpinning our business. 17 is just a recast of that same data. Again, I think it's a very strong visual to see prices recovering as sharply as they are. You know, average prices in 2020 were a historic low at $1.90, and yet we've delivered the margins that Rusty talked about. But it's nice to see that we've got a tailwind behind the commodity with nearly $1 recovery in pricing for next year. While you see that curve, if you recall on page 15, the curve tick back down, we think that as the market gains added conviction that ultimately the oil rebalancing is sticky, that price will continue to come up. And with firms like Occidental Petroleum just announcing a significant write-down of their assets and a significant reduction in activity from the Permian Basin, I think that will certainly put additional tailwinds behind natural gas. As we move to 18, this is just a quick snapshot of our hedge portfolio. And we just remind you, we're 91% natural gas and just 8% natural gas liquids. So 99% of what we produce is very clean natural gas, just 1% of crude oil. And you see our focus is certainly very much on the natural gas hedging. We opportunistically layer in NGL and oil hedges, but every morning we begin our day by looking at where natural gas prices sit, and then we look at all the basis differentials across the basin, and we'll opportunistically layer on. So over the next few months, you'll continue to see 22 and 23 begin to walk up on a volumetric hedge per day basis as we take advantage of some of that contango. It's important to remember that the debt structures that we've done, whether it was ABS1, that was the first long-term financing we did late last year, and then the two most recent that we did in this half year, are underpinned by very long life hedging portfolios, anywhere from 10 to 12 years. And so you see, that's why we have such nice base protection going out several years at a price that allows us to earn a very compelling margin, protect the cash flows, to not only pay the dividends, but also to pay our debt. So it puts us in a very healthy position. The bottom part of the slide, I won't spend a lot of time there. We did have a mark-to-market during the period on our derivatives, marking that to a $40 million liability. And we just make the point, there are very few companies out there, if anybody, like Diversified, that have a 12-year hedging portfolio in place. And so there's a lot of time option value in that program. And that option value is ultimately worth $70 million to the counterparty. But if you looked at the strip at where it's at June 30th, if we were to unwind our hedge book at the prices on that strip, it would actually still be a $31 million cash contributor over that period of time. Turning to 19, we've talked about our capital structure, and I think it's very important to remember the word simple is what I would use to describe. We essentially have two pieces of debt. If you went back just a year ago, we only had one. We had a company credit card, the revolving credit facility underpinned by 17 member banks. But we knew it wasn't the appropriate thing to do to put long-term, long-life assets, the equivalent of our house, on a credit card. And so we looked at longer-term financing structures, and frankly, we didn't see anything we liked. They were too expensive, certainly relative to the credit and risk profile of what Diversified is. And so we worked ultimately to create our own financing. And so while you see ABS1, ABS2, and the secured term loan, I think it's important to remember those are simply just long-term amortizing notes. That's all they are. They're underpinned by the upstream assets, the producing wells that we have. In fact, ABS1, ABS2, and the RBL all share in the exact same wells as the collateral. They just share different working interest in those wells. So very stable and simple capital structure. Importantly, 70% now is long-term, fixed coupon, and amortizing. And the lower left-hand portion of this page just shows how this debt will roll off systematically, which is why that underpinning hedging is so important, because we've locked in the cash flows that will pay that debt off and also allow us to continue to pay the dividend, both of which have been so instrumental to our story. But you add it all up, and we're less than, we're well beneath our 2.5 times self-committed governance on our leverage ratio, and well under the 3.75 times that our credit facility would allow. We sit at just 2.2 times today, with that delevering profile that will very quickly take us sub 2 times. And I'll wrap up on 20 talking about what was, I think, a remarkably successful redetermination process. The biggest thing here is to remind, we'll get the questions about the type of assets we have and the quality of the underlying assets. And I think it's important to remind that we have 17 member banks that look very closely at their collateral and have taken a hard look at all of their portfolio's collateral. And you can see across Appalachia that we were one of just 3 companies that held the borrowing base flat, and one of only 2 companies that not only held the borrowing base flat, but were able to sustain low pricing and favorable covenants. Every other company either saw reductions in the borrowing base, some as sizable as 42 and 37%, which speaks to the underlying nature of the declines in their portfolio and how quickly they roll off, or they had to accept more expensive pricing or less favorable terms. In fact, one of the most common provisions added this time around, and I think you'll all appreciate why, was a provision called anti-hoarding, where the banks prohibited a defensive draw on the facility as companies were ultimately trying to shore up in a very volatile time. Banks had said, we're going to prohibit your ability to do a defensive draw, and we did not have to accept or add that provision. It speaks to the bank's confidence in the underlying cash flows and the trajectory of our business model. So with that, I'll give it back to Rusty for final comments, and we'll start Q&A.
All right. Well, just looking at the rest of the year and as we move forward through the next 6 months, just some strategic near-term priorities. Number one, the integration. We've closed 2 acquisitions, obviously in May. The integration of those 2 assets continues with the emphasis on looking for synergies, efficiencies in the operations, and enhancements to the production profile of both of those transactions. We'll continue to monitor the commodity price environment. Obviously, it's improved significantly in the last couple months, and we'll look at opportunities to continue to improve pricing in the out years. We're always looking a couple years out, with all the production that we have hedged, over 80% hedged through the end of 21. Obviously, 22, 23 are a main emphasis for us at this point. We'll continue to look at opportunities to grow the business through acquisition. We'll do that in a very disciplined manner, making sure that we don't overpay, and at all costs, making sure that we protect the balance sheet and not extending ourselves from a leverage perspective. Our focus will continue to be on the operations, on the day-to-day operations of the business, making sure that we're blocking and tackling and doing all the right things to make sure that the company is operating at a very high level. And then more coming up here in the next few weeks is the valuation period for inclusion into the indexes. Since we moved up to the main board, we missed that opportunity in the second quarter because of the timing of our uplist, but the third quarter will give us the ability to hit these indexes, the all-share index, which is gauged, I believe, in the next couple weeks, along with the FTSE 250. So that would be a possibility of being announced in the first week or so of September. So those are extremely important to us as a company to be able to get that passive investing or passive investment in our company and to give more daily liquidity in the shares. So with that, I will stop there and turn it over to for any questions that maybe anybody has.
That is great, Rusty. Thank you very much for you and the team for such an interesting presentation on the company. Another fine set of figures and continued good progress across the board. We've had a few questions come in. We had a few questions ahead of time. And just a reminder, if you do want to ask a question, there's a Q&A box at the bottom of your screen. So please just type it in there and we'll try and run through those questions. So kicking off the questions, first one is sort of on provisions, and it says, what provisions are being made for decommissioning liabilities, and are these spelled out in the notes to the financial statements?
Yeah, so it's a good question, and we have a portfolio that's unlike anybody else's, and so it's a question we get often. For those who are newer to the story, I'll start by reminding that we do include on our website a supplemental presentation that very detailed and very methodically goes through our asset retirement obligation and how we think about it, and how the numbers are derived to hopefully provide a bit more clarity there. But I think it's important to remember that, you know, we refer to it as safe systematic retirement of wells because we have a very long life portfolio. The average remaining life is over 50 years within the portfolio. Some will need to be put to bed sooner and some will go beyond that. And what we've done is to be very proactive, is to work with every state in which we operate to put in place agreements that give visibility to both the regulator, visibility to us as the operator, and visibility to our investor as to how that program will ultimately unwind. And if you looked at the agreements that go for 10 years in 2 of our states, 15 years in the other 2 key states that cover 99% of our wells, what you find is that we're compelled to plug around 80 wells a year. Now we'll probably plug anywhere from 85 to 105 wells at an average cost of anywhere from $20,000 to $25,000. And so you're looking at around $2 to $2.5 million of cash expenditures. And of course, that's against a backdrop of over $300 million of EBITDA. So less than 1% of our EBITDA goes to do that. Now that's now, you know, you'd have to go out decades before you see that the mix begin to meaningfully change. One, because the agreements are 10 to 15 years, but 2, is the wells will begin to roll off. And so what we've done in the supplement is we actually show, given an illustration of how the portfolio would unwind over that period of time and how the cash flows from the assets would retire the assets. So you're looking at, you know, to give simple terms, about $6.1 billion of undiscounted cash flows after operating expenses to retire about $1.6 billion of wells, which leaves the $4.5 billion residual to pay dividends, to pay the administrative expenses of the company, to pay our taxes and our interest, to repay all of our debt before you ultimately put the portfolio to bed. So we spent a lot of time focused on this and doing our best to convey what's a very long-lived asset obligation. And so hopefully that's helpful.
Okay, great, thank you. Second question here. How does Rusty feel in the light of the massive write-downs at BP and Shell about the global trend away from fossil fuels, and how well positioned is Diversified Gas and Oil in facing such consumer adversity?
Yeah, I think obviously a big question as we've looked out there and we've seen companies like BP take a different approach and strategy. I think it's worth noting that they took that strategy and at the same time decreased their dividend. And it will be interesting to see over the next 10 years as they lower their carbon contribution to their overall revenue stream, how much further that dividend will have to drop over that period of time. It's a tough one for me to look at and say we're going to take our investment in carbon away and take that investment and put it into even higher cost of capital projects and somehow, some way make money. It's a struggle for me to figure that out. However, you know, the one thing we've said all along is we are a very good carbon story. We obviously feel, and most of the U.S. obviously feels that natural gas is a fuel for the future. Power generation continues to move to natural gas from coal, which is a positive story from an emission standpoint, a carbon emission standpoint. We also are operating existing wells, which means as we enhance production on existing wells and improve production, that's less production that has to be drilled to meet the demand here in the U.S., which is a positive story also. We feel like that we have a very positive story as it relates to that. more gas means less carbon dioxide. So we're keeping the strategy focused on that. And we feel like that the strategies of saying, we're going to zero carbon is going to be tough to hit for those companies. And I look at that and say, I don't know what the long-term viability of companies that say they're going to do that, how that's going to play out.
Okay, thank you. What about your operating costs here, and how do you manage to keep costs so low? Are you cutting corners anywhere?
Well, we cut corners based on the fact that we try to become as efficient as we possibly can in the operations. Of course, we don't cut corners. What we do is we're adding a lot of production, a lot of wells, a lot of infrastructure in a geographically concentrated area, and we're taking advantage of that by being able to really find synergies that you can run through the whole operation. More production, with less people, because the assets are so concentrated, and we're able to, consolidate compression. We're able to, consolidate pipelines and gas flows and get gas to better markets and all that. So it's really just becoming a much larger operator with a lot of efficiencies built into the operations. But no, we never cut corners. We'll always have safety and at the top of our list before we do anything.
Yeah, and I think the production speaks to that, right? If we were cutting corners, then you'd see a rollover in production because we wouldn't be properly maintaining our own wells. I think Brad's done a great job of instilling a culture where if it's not adding value, let's not spend it, let's not do it. And so we really have just asked the team to focus on what ultimately drives the bottom line. And I'm reminded we had, as part of our financings, the rating agencies visited the field, and I love telling the story that the principals from Fitch observed to our ops gentleman who was leading the tour that it sounded a lot like he ran his own P&L by the way he talked about his assets. And he looked at him, and in all candor, I wondered if he knew what a P&L was. And he said, I do. I know what gas sells for, and I know what I'm asking to do costs. And I'm always mindful of whether or not it's going to drive value to the bottom line. And so I think it really speaks to what Brad's done with his team to be very, very focused on every unit counts and every dollar matters. Great,
thank you. I guess a related question to that is, can you give a little bit more detail on how you keep your decline rate so low, because they are pretty impressive?
Yeah, Brad, go ahead.
Okay. Well, as Eric mentioned, we're very focused not only on cost containment, but also on our production metrics. And we have 4 daily operating priorities. Number 1 is safety. Number 2 is production. And we say every unit counts. 3 is efficiency, every dollar counts. And 4 is enjoyment. But that second one of production is we empower our employees at the field level, at the well level, to look for opportunities to improve production. We give them responsibility, we give them funding, we instill accountability, and we really have just instilled that culture of building a successful company starts with our production. None of us receive a paycheck unless we're producing good, solid units of production, and so that's a very simple message, but one that resonates at the field level. And so it's an item that we talk about every day. We have a lot of fun with it. We build in competition. We create competitive environments. And so those are some intangible type items. But we have a very experienced team with these acquisitions that we've done. Not only are we buying physical assets, but we're bringing on a team of people that have worked with these wells, have worked with the pipelines for in many cases, decades, 10, 15 years. And so they're very knowledgeable, and they've worked for companies that really did not give them the ability or the empowerment to make production improvements. And so we've got, with this legacy asset, these legacy assets, it is a very low decline asset base. And so, for us to be able to turn wells back in line, to eliminate some pipeline leakage, to improve production by changing lift techniques, to have daily accountability. We will conduct roughly 5,000 well visits a day with our well tenders. And so we're constantly engaged with our assets, and that's proving to be very beneficial to our results.
Yeah, two stories I'll tell. You know, it really is a cottage industry, and as I've had the opportunity to take investors up into the field, you drive in the trucks, and the guys know each other, whether they work for other companies or ours, and they'll say, man, we need to buy those wells because I know how they're running them, and they're not running them right. And so as we've done that, as we've acquired those wells, they know right how to go in and ultimately leverage our operating philosophy across that well base that drives a tremendously tangible result. And then it is a matter of, you know, as Brad said, we're not moving to build an organization underneath these wells. We bring that institutional knowledge on. And so these guys just immediately move into best practice sharing. And one of those was when we acquired the HG pad of wells. Their wellhead equipment was different than the wellhead equipment that we had on other unconventional assets that we've acquired with Titan nearly 2 years earlier. And so the guys moved and ultimately sold the wellhead equipment that was there and replaced it with wellhead equipment that matched what we already had, which allows the interchange of employees across the pads very easily, as well as simplifies the maintenance because you've got a very standardized outfit. So I think of it as kind of the Southwest Airlines approach of a single aircraft fleet to get efficient. And so these are the ideas that come from that field level talent that does a phenomenal job of maintaining the assets.
Okay, thank you. I've got a couple of political questions here, which I'm going to ask as one. And the gist of the questions are, if there is a Democrat president elected in November, what impact might that have on the cost for the US oil and gas industry? And could it indeed threaten the US oil and gas industry?
Yeah, you know, we've been asked that question a few times, especially as we get closer and closer to the election. You know, I think it's a toss-up right now in terms of who wins this election. I know that a lot of the press would want the Democratic contender to get a lot of the press right now, but I think it's a lot closer than what it looks like on the surface. I will say this: if a Democrat does win, a lot of it will depend on the Senate. If the Senate maintains a Republican majority, it's pretty much a stalemate in terms of being able to really do anything of any kind of, you know, damage to the industry. I do believe, though, that you hear a lot of rhetoric going into an election to placate certain, you know, special interest groups, but as you get after the election, you see things moderate more back toward the middle to be able to get anything accomplished. And I think that the energy situation in the U.S. is always one of those that gets a lot of rhetoric, but typically comes back down to to a realized discussion afterwards. So I think probably, you know, the biggest impact that a Democratic president may have is, you know, federal lands and drilling on federal lands, maybe some regulatory situations around pipelining and those kind of things. I do think that it could end up being a potential price increase for the industry, because I think there's, you know, if there's any kind of additional regulations on fracking or anything like that, the perception will be that supply will be impacted and therefore pricing could go up. So it could be a benefit to us in an indirect manner from the standpoint that, you know, we could see better pricing on the commodity. The only other thing I would say is tax rates, and you just never know about that. But I would anticipate that corporate tax rates would go up. However, as you know, Eric probably was mentioning in the presentation, we've insulated ourselves pretty well from that also.
Okay.
Yeah, just to have a little color, if rates do go up, you know, the federal government offers a tax credit to continue to produce wells during periods of low prices, because these wells are incredibly important to the local economies in which they sit. This is one of the largest industries in Appalachia, and so while in order to continue to pay taxes at the state and local level and to continue to offer employment to thousands of people, there's a credit for producing in low environments. This year, we earned a $70 million tax credit, which based on the current tax rate allows us at the federal level to offset nearly $400 million of taxable income. So when you combine that to the tax credits we already had, that's nearly $500 million of income that we can offset. But the important thing, certainly from an ESG and contributing into the local markets, that's in exchange for continuing to do great things for the local communities.
Okay, thank you. Obviously, acquiring assets is a key part of your strategy. A question is now, how easy is it to buy assets at the moment?
Well, I think, easy is always a tough one to define. I think, what we see is an incredible opportunity set in front of us. Lots of distress in the market, lots of companies looking to divest assets for cash. We saw this morning there was an announcement of an acquisition, really a combination of two shale players that both of them probably had, to some degree, some stressed balance sheets and needed to do something. And this was a way to combine two companies, get rid of a G&A structure, moderate their overall debt profile to some degree. Probably not a great transaction in terms of, the way the markets would look at a transaction. But it's a lower number of players in the market, and that's a good thing. Lowering the number of people that are feeling like they have to put a drill bit in the ground and running the supply of the commodity up. We are in a very good position. We have a great balance sheet. We have funding. We have liquidity. We have the ability to close on transactions and execute on them. So I would say that it's a market that we can take advantage of, and we intend to do so over the next several months.
Okay. And then just, I guess, linked to that is, can you give us an idea about how you actually add value on acquisitions? Are these assets not also attractive to others, making them potentially fully priced?
Well, I think it's more along the lines of everybody wants to do something, okay? But if it was easy, everybody would be able to execute it. And the problem is that there's not a lot of capital available to companies to be able to execute on these transactions. If you've got a highly levered balance sheet, if you don't have access to equity markets, and you don't have access to high yield markets, which nobody does right now, then that makes it very difficult to do transactions. Private equity, they obviously get involved, but their cost of capital is higher than ours. And so it takes them, they're going to have to bid much more conservatively to get the kind of returns that they need. So it puts us in a very good position because we have access to capital and a lower cost of capital to the people that we would typically be in, contention with.
Okay, thank you. Have you ever considered whether the name of the company should be changed, especially since oil only comprises 1% of your portfolio and gas has a far more environmentally acceptable profile, being an important component of any transition to a low carbon world?
Yeah, I think we've been asked that question multiple times. It's kind of a mixed bag. I think that the opportunity to do that would have to come with something, that we did, some kind of catalyst for it, because there's lots of, it's kind of a roll down effect. You change the name of the company to something that's more, neutral as it relates to energy, but then you have to change a bunch of stuff underneath of that. You clear out to the signage on the wells, which is a lot of money to do that. But at some point, I think that you possibly could see us, through the catalyst of some kind of event, maybe change the name and really drop the oil off the name.
Yeah. On the debt side of things, are there any covenants that are material in your debt structure or repayment schedules?
No, I think that's one of the things that was so advantageous to the structures that we ultimately elected to utilize is, we talk and we had some supplemental investor materials to very methodically walk people through what they were, because they were the first of their kind, but in substance, they're very simple notes that are just collateralized by our wells. But one of the things that we did was the debt does sit within, or the assets sit within an SPV that we wholly own, and then we consolidate on balance sheet. But the covenants associated with it, and they're the covenants you'd expect to see, like current coverage ratio, loan to value covenant, they're specific only to that instrument and only to that SPV. So there's no covenants back to corporate. And as long as we meet those very, I would say, simple covenants, particularly given the robust hedging that underpins them, then on a monthly basis, any excess cash flow from those assets is distributed back to the parent, if you will, at the RBL level that we can use for any purpose we like, and there's no recourse back to those instruments. And so they're very covey light, no corporate covenants, and so very, very flexible.
Okay, thank you. We've got a couple of questions here on outlook. One on the short-term outlook, which says, what are the risks over the next 12 months? What could go right and what could go wrong? And then another one just looking a bit further out, just saying, where would you like to be in the next 10 years in terms of production, revenues, etc.? Can you keep acquiring assets and continuing to grow?
Yeah, so talking about the next 6 months, obviously the market is probably the most volatile that we've seen in a long time. And so, the biggest risks in the market to me are just the overall economic impacts of, the pandemic and what's going on out there and kind of where everything just ends up landing at the end of the day. We've seen some positive signs from the U.S. economy. We've seen LNG exports pick up and receipt points starting to receive those again. That's a positive for us in our business, and so that's probably the biggest risk in the near term. But again, as I said earlier, we've done a lot to insulate our business from those kind of things. As it relates to the 10-year, we fully think that the model that we have employed and that we've executed, I've done this for 20 years and have been doing the same thing for 20 years now in terms of how we've run the business. But I do think that as we move through the next several years, you're going to see it may end up being fewer transactions, but bigger transactions as we go. But this model is definitely resonating in the U.S. now. I think that the U.S. institutional investors are looking to for companies to make this kind of switch to more of a cash flow, return on equity focused company or companies. And so I think that we have a bright future as it relates to being ahead of everybody from that manner.
Okay, I'm just conscious of time. I know we're coming to the end. I think we can just time for a last couple of questions which you've got coming through. One is on share buybacks and says, look, what's your view on share buybacks? And if you believe the share price is undervalued, would you either buy shares yourself as a company or as a management team?
Well, we've done both. I mean, I've bought, I don't remember how many shares since the beginning of the year, and so hasn't the rest of the executive team. But we've also bought back shares. Over the last probably year or so, we've bought back, I don't know, it's probably
$60 million, 55 million shares.
Yeah, 55 million shares over that period of time. Is that right? Yeah, it might be more than that. But anyway, right now, what I would say is, as it relates to share buybacks, we do believe that the shares are cheap and undervalued, but at the same time, with the opportunity set that we see in the market in terms of acquisitions, it's still probably, if you compare the two, the rate of return on the acquisitions is still a better deal for us to spend our liquidity and our funds and our capital on than buying back shares at the present time. Now, we saw a period of time when the shares dropped down to, during the early pandemic days of almost clear back to IPO price. And obviously those are the kind of drops where you say, listen, that's where you have to go buy back almost everything you can buy back. But right now I would say that the rate of return on the acquisitions is too good to spend our capital on something else.
Okay. Thank you very much. That brings us to the end of today's webinar. Rusty, Eric and Brad, thank you very much for presenting. Thank you for everyone who has attended. And if you have any questions that haven't been answered today, please could you send them to info@yellowstoneadvisory.com. Our next webinar is on the 24th of August when Kenmare Resources Management will be taking you through their half-year results, which are released on the 19th of August. So goodbye, thank you for attending, and we hope to see you again soon.